Hi YouTube, it's Average Joe, your channel where we talk about anything around personal finance and smart money moves for the everyday guy. Welcome back to our channel. Today we got an incredibly valuable video for you. Mastering Debt Management, Your Path to Financial Freedom. By the end of this video, you'll have a clear roadmap to tackle debt, know which types of debt to watch out for, and discover the top strategies to become debt-free. We'll start off with the various types of debt and their impact. You'll learn about various debts, from the manageable to the potentially devastating. We'll break down the most common types and discuss how they can affect your financial well-being. What exactly is debt? Debt is money you owe to someone or some institution, and it comes in various forms. First, we have credit card debt. This is one of the most common and often the most dangerous types of debt. Credit cards come with high interest rates, which can quickly snowball if you don't pay them off in full each month. Credit cards offer convenience and flexibility, allowing you to make purchases and pay them off later. However, here's where the trap lies. The average credit card interest rate, according to Forbes in October 2023, is over about 28%. If you only make minimum payments, you'll find yourself caught in a never-ending cycle of debt. So, how do you manage credit card debt wisely? First, always pay more than the minimum. Minimum payments barely scratch the surface of your debt and mostly go toward paying interest. By paying more than the minimum, you reduce the principal balance faster. Create a budget that accounts for your credit card payments. Knowing exactly how much you can allocate to debt repayment will help you make consistent progress. Cutting unnecessary expenses and reallocating funds can free up money for debt reduction. Negotiate with your credit card company. Believe it or not, credit card companies may be willing to lower your interest rate or work out a more manageable repayment plan if you communicate your financial hardship or willingness to pay. If you can't control your spending, a credit card is not to be suggested. It will most likely create more harm than benefit. The feeling of being unlimited can quickly take over. Next on the list is student loan debt. Many of us pursue higher education, but student loans can hang over your head for years. Understanding your repayment options and creating a plan is vital to managing this type of debt effectively. Student loans are unique in several ways. They often come with lower interest rates compared to credit cards or personal loans. However, the severity of student loan debt can vary based on factors like the type of loan, the total amount borrowed, and your post-graduation financial situation. This is a vital part as your future job situation should yield enough for you to carry the loan without a burden. What is the difference between federal versus private loans? Federal loans typically offer more favorable terms, including income-driven repayment plans, loan forgiveness programs, and lower interest rates. Private loans may have less flexibility and potentially higher interest rates. Student loans often come with various repayment plans. The standard plan typically involves fixed monthly payments over a set period. Income-driven plans, on the other hand, adjust your monthly payments based on your income and family size. If you're dealing with student loan debt, here are some strategies to consider. Stay informed. Know the terms and conditions of your loans, including interest rates and repayment options. Explore loan forgiveness programs. Depending on your career path, you may qualify for loan forgiveness or repayment assistance programs. Make extra payments. If possible, make extra payments towards your student loans. Refinancing. Consider refinancing your student loans to secure a lower interest rate. Mortgages are another common form of debt. A mortgage is a loan that you take out to buy a home. While they're typically lower in interest compared to credit cards, they involve substantial sums of money. Managing your mortgage wisely can help you build equity in your home and secure your financial future. Always calculate for a higher interest rate to understand how you would be financially affected by it. From there, you will have a better understanding of what you can afford. Here are some key aspects to consider when dealing with mortgages. Interest rates. Mortgages can have either fixed or adjustable interest rates. A fixed-rate mortgage means your interest rate remains the same throughout the life of the loan, providing predictability. Adjustable-rate mortgages, ARMs, may offer lower initial rates but can fluctuate over time, potentially increasing your monthly payments. Loan terms. Mortgages come with various loan terms, commonly 15, 20, or 30 years. A shorter loan term typically means higher monthly payments, but less interest paid over the life of the loan. A longer term reduces your monthly payments, but may result in more interest paid overall. Down payment. The amount you can put down as a down payment affects your mortgage terms. Here are some practical tips. Budget for more than just the mortgage. Consider all homeownership costs, including property taxes, insurance, maintenance, and utilities. This ensures you're financially prepared for homeownership. Understand your loan. Know the terms and conditions of your mortgage, including the interest rate, amortization schedule, and any prepayment penalties. Refinance strategically. Refinancing your mortgage can be a powerful tool to secure a lower interest rate, reduce monthly payments, or shorten the loan term. Remember that a mortgage, when managed wisely, can be considered good debt. It allows you to invest in a valuable asset, your home, which can appreciate over time. Auto loans or car loans are often necessary to purchase a vehicle, but they come with their own set of considerations. Understanding the terms of your auto loan and exploring alternatives can help you avoid overpaying for your wheels. In essence, if you cannot pay for the car in cash, you cannot afford it. Cars do not appreciate in value. Auto loans are unique in that they are often secured loans, meaning the vehicle itself serves as collateral. This reduces the lender's risk, typically resulting in lower interest rates compared to unsecured loans like credit cards. Here are some key aspects to consider when dealing with auto loans. Interest rates. Auto loan interest rates can vary based on factors such as your credit score, the loan term, and the lender. Securing a lower interest rate can save you money over the life of the loan. Loan terms. Auto loans come in various terms, commonly ranging from 36 to 72 months. A shorter loan term results in higher monthly payments, but less interest paid overall. Longer terms offer lower monthly payments but may cost more in interest. Down payments. Making a substantial down payment can lower the overall cost of the vehicle and reduce the amount you need to finance. It can also result in better loan terms. Managing your auto loan wisely is essential to ensure it doesn't become a financial burden. Here are some practical tips. Set a realistic budget. Determine how much you can comfortably afford for both the car payment and associated costs like insurance, maintenance, and fuel. Shop around for rates. Don't settle for the first auto loan offer you receive. Shop around and compare interest rates and terms from different lenders to secure the best deal. Consider paying fully in cash. To reduce any risk at all, it's suggested to avoid a car loan and buy the car in cash. If you struggle to do so, the car is often too expensive for you. You most likely don't need a brand new vehicle. And finally, we have personal loans, which can serve various purposes from consolidating debt to covering unexpected expenses. While they provide flexibility, they can also lead to financial strain if not managed wisely. Here are some key aspects to consider when dealing with personal loans. Interest rates. Personal loan interest rates can vary widely based on your creditworthiness and the lender. Having a good credit score can help you secure a lower interest rate. Loan terms. Personal loans typically come with fixed terms, often ranging from 12 to 60 months. A shorter term results in higher monthly payments but less interest paid overall. Longer terms offer lower monthly payments but may cost more in interest. Purpose. Personal loans can be used for various purposes, from consolidating high-interest debt to covering unexpected medical expenses. It's essential to have a clear purpose for taking out a personal loan. Ask yourself, do I need this loan? In an ideal situation, you would have an emergency fund that would cover potential costs that this loan would be needed for. Many may wonder if there is good debt versus bad debt. It's a hot topic, and we'll give you a comprehensive understanding of which debts can be considered investments and which should be avoided like the plague. Let's start with good debt. Good debt is typically associated with investments or purchases that can potentially increase in value over time or provide long-term benefits to your financial well-being. An example of good debt is mortgages. When you take out a mortgage to buy a home, you're investing in an asset that can appreciate over the years. Plus, mortgage interest rates are often lower compared to other types of loans. Another example of good debt is student loans, especially when they enable you to obtain a higher education that can lead to better job prospects and higher earning potential in the future. Now let's move on to bad debt. Bad debt is typically associated with purchases that quickly depreciate in value and do not contribute to your financial future. An example of bad debt is credit card debt used for non-essential impulse purchases or everyday expenses that you can't afford to pay off in full each month. Credit card interest rates are often high, and carrying a balance can lead to financial trouble. Another example of bad debt is car loans. If you can't pay the car in cash, you cannot afford it. That is the simple way to think. Cars are depreciating assets, which means you would invest in something that loses value over time. Consider what cars you could buy without a loan that would still take you from A to B. Understanding the difference between good and bad debt is crucial for making informed financial decisions. Now let's get to the meat of it. It's common to have various debts, from credit cards to student loans and mortgages. But how do you decide which one to tackle first? Let's break it down. First, focus on your emergency fund. Make sure to have around $1,000 in case of any emergency. Once your debt is paid off, or at least the harmful debt, you can start giving your emergency fund some more love. It should consist of 3 to 6 months of living expenses. Secondly, focus on high-interest debt. This is typically your credit card debt, which often carries sky-high interest rates. The longer you carry this debt, the more you'll pay in interest. Prioritize paying off credit card balances with the highest interest rates first. Thirdly, turn your attention to high-interest personal loans, such as payday loans or high-interest personal loans. These debts can quickly spiral out of control due to their exorbitant interest rates. Next in line are debts with tax advantages. These are debts that may offer tax benefits, like mortgage interest, or student loan interest deductions. While these debts may have lower interest rates, consider the potential tax savings when deciding whether to pay them off early. The key takeaway here is that there's no one-size-fits-all approach to debt prioritization. By strategically tackling high-interest debt first, you'll save money on interest and pave the way to financial freedom. Becoming debt-free is not just about paying off existing debts, it's about maintaining a lifestyle that prevents you from accumulating new debt. Let's dive into some essential strategies. Build an emergency fund. One of the key pillars of staying debt-free is having a financial safety net. Establish an emergency fund with at least 3 to 6 months' worth of living expenses. This fund will help you weather unexpected financial storms without resorting to debt. Live below your means. Avoid the temptation to spend every dollar you earn. Instead, practice frugality and spend less than you make. This creates a surplus that can be used to pay down debt or save for the future. If you want to learn more about this, look at our video about frugal living. Set financial goals. Having clear financial goals gives you a sense of purpose and direction. Whether it's saving for a dream vacation, a new home, or retirement, having goals motivates you to stay on track and avoid unnecessary debt. A comprehensive guide to mastering debt management and achieving financial freedom. Remember, taking control of your debt is taking control of your future. If you found this video valuable, please give it a thumbs up and subscribe for more financial wisdom. As always, if you have questions or want to share your debt management journey, drop a comment below. Our community is here to support you. Until next time, stay financially savvy and debt-free.